Good morning and good afternoon, all attendees. Welcome to the eighth episode of the webinar series, How to Learn Forex Trading. I'm Nikhil Malhotra, and on behalf of GTC, I'm going to co-host today, co-present today's episode along with Ms. Shipra, who is the trading psychology expert. So till now, what we have understood, we have understood the concepts of technical analysis, how to trade the financial markets, how to trade the markets online on the basis of technical analysis, various aspects of technical analysis like what is chart, different time frames, how to read chart, how to read candlestick patterns, what are different indicators, and how to apply different trading strategies. Now, along with the theoretical concept of technical analysis, trading online techniques, it's also important to pay attention to the trader's psychology because trading is very, very emotional. As a human, our emotions are attached to the profits and losses. So let's listen from Ms. Shipra.
Hello, everyone. I hope you all are doing great. So thanks a lot for taking out time and attending this webinar. And thanks a lot, Nikhil, for having me here on behalf of GTC. So I have been a trading psychologist for a couple of years now. And what is basically trading psychology? So it refers to mental and emotional state of a trader, which impacts their trading decisions. So there are various aspects as to how a trader's psychology can affect their trading decisions or their actions in trading. As you have learned in the previous webinars through Mr. Nikhil, that about technical analysis and about the theoretical knowledge. So when it comes to the real world of trading, the real test is your emotions, various emotions like fear, greed, fear of missing out, fear of losing your money. So there are n number of emotions which you will face during your trading journey. You all must know that 80 to 85% of the traders fail in the market. They fail to make money in the market. And because their trading psychology or their emotions come into play, wherein their decisions are their emotions are basically overpowered by their trading decisions. The trading decisions are overpowered by their emotions. Now let's see by a few examples as to what are the events which can affect a trader's psychology. Okay. Recency bias. So what is recency bias? For example, a trader takes 40 trades, okay, out of which 30 are probably wins and 10 are losses. Now, he was lucky enough to get some amazing wins in the beginning of the month, say. But during the course, he faced 10 consecutive losses. So his psychology, his decisions will be impacted more by the set of recent events which has happened. So the events which happened in the further past will not matter to him. So if you see in total, he has made 30 wins and 10 losses. So overall, he would be profitable. But then his decisions are overpowered by the recent losses, right? What do you say, Nikhil?
Exactly. So basically, whatever has happened in the recent past, okay, it impacts you more. It's not only the case about the losses. It may happen in the other scenario as well. Let's say you started the month with not so good win ratio. Okay, you had some okay type of trades. You won some, you lost some, but recently you have had a series of 5, 6 profitable trades. So now here I'm giving an example. I'm talking about the opposite scenario. So what will happen now because of the continuous consecutive wins in the past 5, 6 trades? You'll be overconfident. Okay, so because in the beginning of the month, if your trading technique, your trading strategy didn't work, that's the reason you were not into consecutive or majority of the wins. But because you have won the recent trades, a series of trades, so now you are overconfident. It may again lead to overexposure, over trading, such kind of habits. So I'll ask Ms. Shipra to explain a bit more about trader psychology with some more examples.
Yes. So as we all know that, I have seen across my career span, I have met a lot of traders and I have seen how what is their trading journey like. So I've seen and I've noticed this and I've observed this a lot of times that everyone is a profitable trader until they're trading on a demo account. Now, why is that? Do you all know why is that? Can we have a few answers? Have you guys ever traded on a demo account? Or you straight away jump to real-time trading? Can we have a few answers in the chat?
Are you trading on a demo account or you have started trading on a real account? Can we have the answers, please, from the audience?
Okay,
Both.
so we see both, and we see a couple of people who have probably experienced only demo. Okay, so the real test is, one second. So the real test is when you actually get to a real-time trading account. Why is that? Because in a demo account, neither do you have a fear of losing, nor are you overwhelmed when you make more money, right? So everyone is practically profitable always in a demo account. And let's see how you can overcome recency bias. Okay, so what happens in recency bias? Because I've given you an example of losses, so what happens? So you are so affected by your recent losses that fear comes into play. Now you are very fearful that you may lose your capital. You are scared to take a trade setup. You are scared whether your analysis will be right or will be wrong. You are scared that your account could go into a drawdown. So that is what recency bias does to you. It will create a fear in you. It will shake your confidence, and you will start doubting yourself. You will start doubting your trading strategy. You will start switching from one strategy to another in pursuit of finding a better strategy. So it's not actually the strategy which is wrong. Sometimes the market is constantly changing. It's not like the market will always be trending, whether it's upward or it's downward. The market could be ranging sideways. So that could also be a potential reason of your loss. But you get a fear and you try switching from one strategy to another. I guess Mr. Nikhil is much more experienced in this field. So let's hear it from him.
By the way, it reminds me to announce we have a special benefit during the webinar if you want to open your real trading account. For all the new traders, if you want to start a new trading account with GTC, only during this webinar, you can use the account opening link given in the chat box, and you'll be given a special advantage apart from the 100% first deposit bonus on the minimum $200 account. You'll be getting $100 preloaded in your trading account. All right. Yeah. So now let's proceed with the topic. So as Ms. Shipra has told, because you have started losing now because of the consecutive losses, fear sets in the trader. It's not necessary that your trade or trading technique is wrong. Okay, you must have taken the trade after all the parameters going in the favor of the trade. The potential outcome of the trade should have been positive, but due to whatever reason, this is market. And market, there is nothing 100% confirmed at all times in the market. Okay, so this is the basic concept of financial markets. They can change due to whatever reason. They can change at any given point of time. That does not mean that you also start changing your trading techniques or the strategies. So you should stick to that. You should complete a minimum number of trades. It's always advisable to stick to your trading strategies for at least 50 trades. Okay, on the basis of 50 trades, then you can analyze what was your win rate. Have you always followed your trading techniques, the parameters, the plan, or you have diverted in between? You should always analyze on the basis on the what do you say, the sample size of at least 40, 50 trades, not on the sample size of 5, 10 trades.
So let's see how you can overcome recency bias. So the best way to avoid such psychological factors affect your decisions, you have to start maintaining a trading journal. Now, what is a trading journal? It is basically just a set of records, which it's like a log, okay, with the date, with the entry price of your trade, with the stop loss, with the take profit, and why you took that trade setup. So by doing this, you are creating a data for yourself, a reference for yourself. It could be, I mean, there are various ways of maintaining a trading journal. It could be just in Excel. It could be, you get trading journals, by the way, online. You can purchase a trading journal like a logbook. Or even we have certain websites wherein you can link your account to that website, and you will have your entire history of trades like a trading journal recorded for you. So I think one of the websites is
MyFXBook.
myfxbook.com.
You can create your account at MyFXBook, and you can link your existing account, whether it's a demo account or a real trading account. You can link your existing MetaTrader account with your FXBook. Now, FXBook starts maintaining your job. It starts giving you the analysis of your trades, how many trades you've won, what is your success rate, what was your drawdown percentage, and how aggressive you were in your trading, what kind of trader you are. So you'll get a complete analysis of your trading style. Okay, it's like your report card.
Yes. So now you will know that you are making your trade decisions based on logic and not based on emotions. So it is very important to maintain a trading journal to keep assessing yourself. Right. So unrealistic expectations. This is one of the most common notions. So whenever someone wants to start trading online, I get this a lot. So they will have some unrealistic expectations. Okay, let's hear it from the audience that what is the amount you want to start your account? What is the amount that you want to earn on an everyday basis or a monthly basis, say for a monthly basis? So what kind of amount do you want to earn from Forex trading or online trading? May it be Forex, may it be currencies, Forex and currencies, may it be stocks or indices or commodities. So what is the kind of return you guys want to have on a monthly basis? Can I have a few answers in the chat, please?
Write down the figure, whatever you want to make on a monthly basis.
$2,500. Okay. Any more answers?
Okay. Do you have any idea to make 2,000, let's say for a figure of $2,000, just on the, just for the example basis, okay? Let's say if you want to make $2,000 per month from online trading, do you know what kind of capital is required to make $2,000 on monthly basis? And what kind of percentage returns you're expecting? It all depends, like how many, what percentage you're expecting per month.
Someone is actually very realistic. He's mentioned 4%. So the audience are well aware.
Yeah, that's good.
That's very good.
Okay, I'll give you a simple formula. Let's say you are expecting around 10 to 15% returns per month, which is decent in online trading. Okay, if you are skillful and you are consistent in your results, you can target easily 10%, 15%, even 20% on monthly basis. Now, just for the sake of calculation, let's assume you'll be getting 15% returns on monthly basis, and to make $2,000. So what you'll do, it's a simple mathematical formula. Take 2,000, multiply with 100, so 2,000 times 100, and divide by 15. So the answer would be somewhere around 13,300 something. So let's round it off to 13,500. So in order to make $2,000 on a monthly basis at the average return of 15% per month, you should invest at least 13,500 in your trading account. So this is how you would calculate how much capital should be invested, what kind of returns you can expect on a monthly basis. And it's a long-term game. Okay, don't expect to be millionaire overnight. That's the common problem.
Yeah. So we've seen people, treat trading not as a business. So they have some unrealistic expectations, bizarre expectations. So say, for example, if you have to start any business, you want to open a shop. So what will you do? You will do some research about that industry. You will make some investment in the compliance or the regulations of whichever country you are in, or whichever industry you want to open. I mean, whatever product you want to open, you want to sell through your shop. So you will make a certain investment, and you will wait, you will do some marketing activities. So you're going to do a lot, right? And after that, you are ready. You have accepted for a fact that it will take some time. Every business has a gestation period, say for about 6 months, about 1 year. But when it comes to trading, you want to be a millionaire overnight. You want to invest a small amount and double your money, triple your money in a very short time. So I think we should treat trading as a business rather than a get rich quick scheme, right?
Exactly. So I'll tell you one thing. See, whenever you want to open a shop, you want to sell some products through your shop. Okay. Now you understand. You have to invest in the rentals. You have to pay some advance rent. You have to buy some trade license. You have to buy the products. So there are multiple investments. But when I talk about online trading, the only investment which comes to your mind is the amount of capital required
And the time.
and the time. So the fact is, apart from the capital invested in your trading account, you should also invest in the education. Okay. Most of the traders, they fail because they don't invest in education. Number one. Number two, you should also invest in yourself to upgrade in terms of the concept of the trading, in terms of getting the techniques and strategies of the trading. Also, invest your time to practice a lot. And number three, also invest in building your emotions, means building your patience,
Discipline.
discipline. Okay. So as a trading is a game of psychology, to be very honest. I've seen so many cases where people start taking trade calls from successful traders. Still they can't make money. If they're buying trade calls from a successful trader, okay, then they should be making money. It's very easy to copy paste a trade call, but still they don't make money because they fail emotionally.
Right. So what happens? Trade analysis becomes secondary to your emotions. You become emotions like fear and greed, they come into play. So you are not able to think rationally. You start thinking emotionally. You get emotionally attached to your trades. You get emotionally attached to the your account statement. So you will spend more time and you will become a habitual trader. So if you've had a series of losses, you will become a habitual trader and you will try to overtrade, right? So you will try to recover your losses. You will not wait for good quality trade setups because fear and greed come into play and they ruin your trading plan.
Okay. I would like to ask the audience once again, what is the barometer of success in trading? Is it the amount of profit you're going to make, or is it the success rate, the win rate? Can I have the answers? Exactly. So many times I tell my clients that you should not analyze your success on the basis of the profit result. You should always analyze your progress, your success in trading on the basis of your win rate. So let's say you have just started trading. Okay, you're very new to this trading world. In the first month, your win rate could be 40%, could be 30%, could be as low as 20%. It doesn't matter. Go back to your demo account, practice again, apply these strategies, come back again next month. Now, if in the next month, if your win rate has improved from 20, 30 to 40, or maybe 50, you are improving. Then after 2 months, if your win rate has improved from 40, 50 to 60, 70. So this is how you should track your progress instead of counting on the amount of profit.
Yeah. And you get emotionally involved. You basically try to impose a setup. Even if you're not finding a good tradable setup, you will try to impose it. You will find reasons to trade. And unfortunately, when you will make a loss, you will be the last person that you will blame. So you want to blame it on anyone and everyone except yourself. You are not in a state to accept your mistake. So you tend to blame the market. You will say the market is manipulating. You will say market was on a stop loss hunting spree, and then maybe it was some news or some economic event which turned my trade against my favor. So and and a very funny thing, you will start blaming. You will become a religious trader. You will say, oh God, this is the last trade which I have taken, and you will suddenly turn into a religious trader. Please turn it in my favor, and after this I promise myself that I will never take a bigger or a higher risk trade. So these are the effects of emotions when when your psychology gets disturbed and your trading decisions get impacted by your emotions.
Exactly.
Okay, risk management. Now, risk management is so even if you have learned what trading is, even if you have learned how to read the charts, you know the best of strategies, and you are very successful in a demo trade. You have back tested your strategies. You feel you are a superhero because you're always making winning trades. But if you don't follow risk management, okay, if you lose track and you don't follow risk management, you will not make it in trading. To be a successful trader, risk management is the key. You have to maintain a healthy risk to reward ratio. And ideally, I think Nikhil has already suggested in the past webinars that you should not take more than 1% or 2% risk per trade. 1% or 2% of your entire capital amount. That should not be traded. That should not be the risk appetite should not be more than 1% or 2% in one trade. So we have also seen that people do not maintain a uniform risk and reward. As we have already told you that 1 to 2 is a good risk reward. It could be a little higher, it could be a little lower, but it is important to stick to your plan, to stick to your risk management rules. And it's evident, like, see, we've just, I'll just explain you with the help of an example that there is a trader, okay? Now he has taken 10 trades, okay? 6 trades are losing trades and his risk was $1,000 per trade versus the winning trades wherein his take profit or the profit per trade was $2,000. So even if, he has made 6 losses and he has made only 4 wins, he's still profitable. So we just have to keep in mind that even if you trade with a lower win percentage and a strong risk to reward ratio, your chances of making money and being a successful and a profitable trader is much higher. Right?
Actually, so I've seen so many traders, I've spoken to so many traders. Once they start losing, okay, let's say they begin with 1% risk per trade. But because of series of losses in the initial trades, what they'll do, they'll start averaging out. Means they'll start taking more number of trades with higher risk because they want to recover. So instead of 1,000 or 1%, I'm just assuming on the basis of this example, that on the basis of this example, instead of 1,000, maybe they'll start taking a risk of $1,500 per trade, or maybe $2,000 per trade. Now, is there a guarantee that if you take a higher risk, the next trade would be a winning trade? No. Nothing is guaranteed in this world, in this online trading world. There is no guarantee. There is a probability. It's a game of probabilities. So we should always, before taking a trade, we should always think of the negative side as well, and always keep uniform risk. If you started with 1%, maintain 1% throughout.
I guess there is someone who's messaging they can't see your screen, but the screen has been shared.
Is this screen visible to all?
I think it is. Okay, so okay. Maybe there is something wrong with their settings. Right, now we're going to discuss about the common mistakes which beginners make and how we can avoid them. Trading without a plan. This is one of the most common mistakes which people do. As we discussed, then when you have to open a new business, you will obviously do some research and you will make a plan as to how you're going to grow your business. Right? So trading without a plan. Plan is basically something like GPS. I'm sure all of you would be using GPS, right, to move from one destination to another. So what happens? You start from location A and you have to go to location B. So you will just enter the details and you will just follow the instructions of GPS. What is GPS doing? GPS is just giving you a direction and an estimated time, right? So a plan is similar to GPS. Even if sometimes, we miss some exit and GPS has to reroute. So we may deviate from our plan, but eventually having a plan and sticking to that plan will make your journey easier. So a plan is very similar to a GPS.
Exactly. Now, as you're following a roadmap, now, what's the help with the roadmap? You know your destination, you're following a route. Okay, there could be some excess traffic, there could be some unforeseen events on the route. You may deviate, you may take some alternative routes, but you will reach your destination. 5 minutes here and there. But it's the probability is very, very high that you're going to reach your destination. Similarly, if you start trading with a plan, you should have a roadmap. You should have a destination, uh, the fixed, the fixed plan, a direction. What do you want to achieve with this online trading? Don't start trading just because you want to make some money. What is some money? Define it. Define your journey. Make a plan and stick to it. So what will happen? Even if on the way, if you find some difficult stages, you are not as successful as you wanted to be. Maybe you're having some initial losses. Maybe your strategy is not working well. Then go back, rework, work towards your plan, work towards your ultimate aim. I'm sure you will succeed. This is the process. There is no shortcut. There is no shortcut to success. You have to work as per the plan. Go step by step. It's not, I'm again repeating, it's not getting rich quick scheme.
Yeah, so basically, if you're trading with a plan, you'll have less stress, right? And you'll have more confidence. So you know if the trades are going in your favor and if you're maintaining the trade plan, you're sticking to the trade plan, you know ultimately that you're going to reach your destination in the decided manner. So another mistake which beginners make is over trading. Okay, stop loss. So trading without a stop loss or modifying your stop loss is a very, very common mistake. Now, why do most of the traders do that? First of all, we all know what is the stop loss. Stop loss is basically designed to limit your loss. So you have, when you analyze a trade and when you take a trade setup based on the confluence of factors or based on whatever strategy you are using, so you will make sure that you put the take profit and you put the stop loss. Sometimes you put the stop loss, but then you keep modifying it. Why? Because you're not able to accept your loss. You don't want to book that loss, but you don't understand how hazardous it is going to be to your account. So if the market doesn't turn in your favor and you have modified the stop loss, it could go into a major drawdown, and you could have unlimited loss. Rather than sticking to a stop loss and putting a stop loss, it'll limit your risk. It'll limit your loss.
All right. How many traders are in this session? They have modified their stop losses in the past. Have you ever done it? You have taken a trade. Now the market is very, very near to your stop loss point. The market is very close to kick you out. So have you started modifying your stop loss? Have you ever done it? Yes or no? Yes.
Everybody is being honest. Most of them have already done it. Yes.
Okay. So what happened in the last? Were you successful? Could you limit your losses with modifying the stop loss? More losses. Yes. So basically, what we are talking today is about your psychology. Now, I've seen so many traders, they are ready to accept a bigger loss means they're even ready to take, like, I'm really sorry to say, they're even good, they're even okay if their entire account is wiped out, but they are not ready to take a fixed amount of loss in a particular trade. I don't know why. It seriously doesn't make any sense. A stop loss is designed to limit your loss. Number one. Number two, why it happens? Why majority of the traders they modify stop loss? What is the basic, the major root cause behind? Any guess? Any idea? When you start modifying the stop loss? I'll tell you. When you start trading with the higher risk amount, the risk amount per trade, which is way beyond your risk appetite. Let's say you started trading with $1,000. So the capital amount you have invested is $1,000. Now, as per 1% rule, 1% risk per trade, how much you should be risking? $10. But you have taken up a trade in which your stop loss was maybe $50, maybe $100. Now, when the market approaches very near to your stop loss, market approaches that level, and you are about to be kicked out of the trade, now you're fearful because you don't want to lose $100 in one trade. So the main root cause of modifying your stop losses is you're trading with a much higher stop loss amount in one trade. And this is beyond your risk appetite. So now you will start modifying in anticipation that market will turn in your favor, your losses will be reduced, your drawdown would be reduced, and ultimately you will make profit in this trade. But it doesn't happen all the time. Majority of the times, if you're doing it, it will lead to bigger losses. Is it right?
Right. Let's move forward. All right. So another, we've spoken about stop loss, and now let's talk about take profit. So, I mean, when you have already decided based on your setup or based on your analysis that this is your take profit and this is your stop loss, you get married to your losing trade, but you don't want to get married to your profitable trade. I mean, you get obsessed with the losing trade and you are holding on to it. You cannot accept it. You don't want to book the loss. But when it comes to profitable trade, you book it early. Why is that? When does that happen? Okay, I know I'll explain one of a situation. So maybe you've had 5 consecutive losses in a row and you have lost like $100 in each trade. So you lost $500, right? Now, when you're getting an opportunity now one of the trades goes positive, you can see green in your account. Now, what would you want to do? You should wait to book. Say the risk to reward was 1 to 2, so you will potentially book $200 if that particular trade setup reaches the target. But since you've had a series of losses and you have lost $500, you will be scared because the market is always changing and the take profit, the market is always moving in waves. It's not like in one candle, most of the times it can't be possible that in one candle you're reaching the take profit. So it'll reach 50, it'll reach 75, it'll reach 100, it may even reach 150, but it may come down again to 50. So that is when you get scared and you book it in 50 rather than waiting for your actual profit target, which was $200. So what will happen eventually? This will mess up your risk to reward ratio. And at the end of the month, I mean, it could lead to losses because you have more number of losses and you have less number of take profit, and also you book them early. Right?
Exactly. So your total amount of losses would be way higher than your total amount of profit on a monthly basis. And what happens once you start losing? Okay, now it disturbs your psychology. Your confidence is lost. So because of the series of losses, the consecutive 5 losses, and now whenever you're seeing green, maybe a smaller amount, you want to book it immediately. Why? Because you don't have the confidence in your trading technique. and you have never tried on a demo account, you have never back tested your strategies, you have never practiced on a strategy. So you're not confident. So you just want to grab whatever is coming to your account. And I've seen so many traders, they will wait for stop loss to be hit. Okay, means if you're taking a stop loss of 100, they will wait for market to reach 100. But they are impatient when it comes to take profit. They want to book whatever comes in front of them.
I think we have a question in the chat box wherein he's saying most of the times market just touches the SL and moves opposite side. Why?
Okay, it's not because of the market that market touches SL and moves opposite side. It's because maybe you're not placing your stop loss at the appropriate level. You have to understand the mechanism of the market. That's actually this question is more about trading techniques. It's not about psychology. The psychology is not putting a stop loss, modifying a stop loss.
Yeah.
Okay, so you have to practice on your trading techniques. You have to practice what should be the apt level to set a stop loss.
Let's move to the next topic.
Yeah.
Overtrading. So what happens when your account is in a drawdown, or when you have lost a couple of trades in a series of you've had a series of losses? So you will tend to overtrade. You will tend to become a habitual trader. You will not wait for good quality setups. You will not wait for the market conditions to be good. You will jump into trades irrespective whether you're getting good quality setups or not. So there is a method wherein you should rate your trades, right? So instead of over trading, you should wait for good quality setups. And what exactly is the rating method, Mr. Nikhil?
Okay, I'm going to explain the rating system of your trades. Let's say you have a trading strategy. Let's take the example of the trading strategy which I've explained in my previous webinar, the MACD and Bollinger Band strategy. Now, if you remember, how many parameters were there for the entry technique? Any answers? If we are going to trade on the basis of MACD plus Bollinger Band strategy, in total, how many parameters were there to qualify for a entry in any trade, either buy or sell?
4.
4. Yes. So the number 1 was the histogram should be green or red. The number 2 was the cross on the MACD. Number 3 was price closing above or below the midline of Bollinger Band. And last was the MACD line should cross 0 level. So in this trading technique or the trading strategy, we have kept 4 parameters. So you should take, before getting into the trade, before entering any trade, how many parameters are qualified as per your entry rule. As a trader, you should not trade if the parameters are not qualified. So some traders, they start taking the trades even if 2 parameters are qualified. They think, oh, 2 are done, and they take it for granted. They assume that rest of the 2 would be done in the process. And if they're not done, if the parameters are not met, the market reverses and they'll have losses. So who's responsible here? Because you have not qualified, you have not rated your trading. So rating means if 4 parameters are set and all parameters are met, then my the quality of the trade is 5 on 5 or 4 on 4. People start trading even with 1 parameter. And that's the biggest mistake. You are so impatient to get into the trade that you don't have the patience to wait for the rest of the 3 parameters to be qualified.
So that's why we say less is more in trading.
Less is more in trading because you'll find less number of setups. You'll find lesser number of trades where all the parameters are qualified. But you'll find more number of trades which are low probability or low quality trade setups where only 2 or 3 parameters are justified and you get into the trade.
So you should not get tempted and let go of those trades which are not meeting the parameters.
So there's a very famous quote. It said, a successful trader is 80% of the times waiting, okay? 10% of the times he's buying and 10% of the times he's selling. So 80% of the time goes in waiting for the setups.
Well, I would say that's a little bit of exaggeration, though. Anyhow, so another cause of overtrading is FOMO. We all know what is FOMO. It is the fear of missing out, right? So let me ask you a question. How many of you like to shop? And what is the discount that you look at, or which sale? Is it a 50% sale that you look forward to? Is it a 60, 70, 80, 90? So how much discount do you guys like when you want to shop, whether it's online or whether you go to the mall? Or I'm sure everybody loves shopping. So what discount percentage do you look at? 70%.
Okay, I'm just going to interrupt in between. I think we are getting some technical questions in today's webinar. See, I'll explain about the volume or the trading strategies in my next webinar, okay, or in the upcoming series. This webinar, today's webinar, is mainly about the traders' psychology. So we have different volume indicators. If you want to know about volume, there are so many of them, which I'll be explaining in the upcoming webinars. Okay, coming back to the topic. So most of the people, they would love to buy on a discounted price of 50 or 60 or 70. Means you wait for the discount.
Right.
Yes, we'll be doing some webinars on price
I
action
guess you're
strategy
getting
as
some
well.
questions in the chat box. So,
And these questions are, I think, they're mainly related to price action or some of the trading techniques. So which would be in upcoming webinars, which would be taken in upcoming webinars.
right. So moving back, you wait for the sale, maybe a month or 2 months. So you wait for the offers or the sales to come in place to go and do your shopping or purchasing, right? But why is it that you do not wait for a good discount in the market to take your position? Would you like to elaborate on that?
Okay, so when we are talking about FOMO, let's say you found a buy setup. Okay, now what kind of setup it is? It is just based on one bullish candle, one big fat green candle, and now you're getting into FOMO state and you want to buy. Wait for the retest, wait for the market to come back. I've never ever seen the market is going straight away up and up and up. It never happens. It may take more time, it may take less time. Okay, that's a different story. But all markets, all charts, once you find the market has started going up, a bullish trend is building, you'll definitely get a pullback in between. You will definitely get a small time correction in between. It's imminent. It's bound to happen. That's the mechanism of the market. That's the way markets operate. Okay. So when you're ready to wait for a discount to buy products online to go for your shopping, okay, then why are you not ready to wait when it comes to online trading? Why you want to buy at the top?
A lot of questions related to technical analysis. So as Nikhil mentioned, we will be covering all the topics in the upcoming webinar.
For sure. All your questions will be taken related to trading strategies, price action, live market trading, everything in the upcoming webinars. Wait for the announcement. We'll have second series of webinar in which I'll be taking it for the price action strategies.
Let's move to the next slide.
Yeah.
Right. So many traders, they make a mistake of getting into trades of the same currency pair or the same currency. For example, a trader decides to buy Australian US dollar, and then they open another trade with Australian Japanese yen, Australian dollar and Japanese yen. Then they may open another trade with Australian dollar and Swiss franc. So what are they doing? They're basically overexposing, on Australian dollar. So if for any reason, due to any economic event, due to any fundamental news, or due to any political news, Australian dollar turns against their favor, so all the trades are going to go against their favor. So why do that? There is a very famous saying that why do you want to put all your eggs in one basket? Why do you want to trade on a currency pair? On one currency pair, there are so many opportunities in the market. There are so many instruments. There are, different pairs. So why trade on one currency pair?
See what happens basically. What I've seen, There are some days, on a particular day, you'll find today Australian dollar is stronger than rest of the currencies. Okay, some days you'll find Canadian dollar is stronger. So obviously, all currency pairs with AUD or CAD would be going in one direction. Okay, now if as a trader I'll start buying all currency pairs with AUD, or let's say I started selling Euro AUD, GBP AUD. So directly or indirectly, I'm going to trade on the strength of Australian dollar. Now, because AUD is stronger, I'm buying AUD pairs. Because AUD is stronger, I'm selling all currencies against AUD. So that's the reason I've taken a trade with Euro AUD sell, Pound AUD sell. Now, what happens if AUD reverses? All your trades will be in losses. So you are overexposing on one currency. In fact, you should mix and match. You should never trade uh, two trades simultaneously on one currency. If you have taken two trades related to AUD, now third trade or fourth trade should not be AUD pair. It could be Canadian, could be Japanese yen, could be something else. Diversify. Diversify your risk.
Move forward.
Do we have a question here?
That's related to the screen share.
Okay. I'm going to remind you once again, if you want to open a new trading account, your Forex trading account with GDC, we have given a link in the chat box. If you are going to use this link, you'll be given a special offer apart from the regular 100% bonus on your first deposit, which should be a minimum of $200. You'll be getting $100 preloaded in your trading account. So let's say if you start your trading account with $200, 200 will be given additional as bonus. Apart from that, you'll be given $100 preloaded in the trading account. So your initial capital instead of 200 would be $500.
Right. Back testing. So what is back testing? You basically okay. You have learned a particular trading strategy. Mr. Nikhil has already taught you a few trading strategies. So you try to implement. What you should do is you should try to implement those strategies with the X number of trades, say 10, 20, 30 times, and back test it. So what will back testing do? It will basically help you give confidence in your system. You will know how is your whether your strategy is working or not, whether it's working in your favor, whether it's not working in your favor, whether you are profitable at the end of say 10 sessions or 20 sessions, or you are losing. So it will give you a chance to improvise on your strategy, to optimize your strategy, so that ultimately you turn into a profitable trader. So back testing is very important. It's like a preparation, like how you have to do a preparation before an exam. It's very similar to preparing yourself or self-assessment, whether your strategy is working or not, and in what market conditions which strategy works in what market conditions. So basically, you will get confident about your system, you will get confident about your strategy, and you will boost your confidence, and you will be successful and profitable if you already know what is your report, or what is your how is your strategy performing.
Yes. So what happens? See, usually if you are trading on the basis of indicators, now as I've told in my previous webinars, most of the indicators, majority of the indicators, they are derived from the price action. So price moves first, then we get to know the indication as per the indicator. So most of the indicators are lagging. So what happens when the market is trending? These indicators would work very well, but there would be some days when the market is not trending. Okay, so when the market is not trending, the strategy is not working well, but because you have back tested and you have gone through these phases, you'll be confident, okay, this is a phase of the market. Once the market trends again, my trades would be positive. And because I'm maintaining a good risk and reward, you'll get to know through your back testing what kind of percentage, what kind of results, what kind of profit you're going to make on a monthly basis. So when you start trading on a real account, you have done it before, you're going to repeat the same process again, and you're confident. But if you have not back tested or live tested, means you have not applied the same strategy in your live account with smaller capital or whatever the capital you're comfortable with as per your risk appetite. Now, once you start trading with a bigger amount and bigger risk per trade, and you have never done it before, now you'll be fearful. You'll be always fearful. You'll never be confident with your trading techniques and strategies, and you will never develop your own style of trading, which is must.
I guess we are getting a couple of questions in the chat box. So let's keep it till for the end of the webinar. So 5 minutes before ending the webinar, we're going to answer all your questions and answers. So we'll just move forward for now, and we'll reply to all your questions. Revenge trading. Right. So when you've had a series of losses, unfortunately, I'm mostly quoting scenarios wherein you are having losses, because we are preparing you for a situation which will disturb your psychology the most. Yes, making profits overnight or sometimes more profits can also put you in a can also affect your psychology in a way that you will be overconfident. But most of the times, the negative state of your account is which will impact you more on your psychology, right? So that's why we've been discussing about losses a little more. But if you follow all these rules, if you follow the discipline, if you maintain a discipline, and if you gain the knowledge and apply these set of rules, what we've been mentioning again and again, you will definitely be not in that state. So we're just preparing you for that state, right? So we're just quoting those examples, not to demotivate you, but giving you a very realistic picture that losses are a part of this game, right? So revenge trading. So when you've had a series of losses, you will end up, taking, you want to take revenge from the market. You want to bring back your money from the market, right? So in that anticipation, you will trade more. You will try to recover your losses as soon as possible. Not only recover, you want it like overnight. You want it immediately. So this is one of the common mistake which beginners make, that they tend to get into revenge trading. And yeah, I think over trading is bad.
Yes, I've seen so many traders. I don't know why they are not able to accept the losses. So whenever they have a loss, now they are ready to fight back with the market. My dear friend, it's not possible. We cannot fight with the market. We have to be friend with the trend. If the trend is there, we can make money. So there's a saying, trend is our friend in the market. Okay. If you're going against the trend, maybe you are trading a wrong setup. Accept your mistake, accept your losses, and move forward. Now, because of revenge trading, okay, you want to win at any cost. It doesn't work like that in the markets. You'll be having bigger losses. Now you have a aim for a bigger revenge. You lost 100, you want to recover 100. Now in the second attempt, you have lost more than 100, maybe 200, maybe 500. Now it becomes a state of emergency. You want to recover at any cost. This is dangerous. If you follow this set of rules, if you follow a uniform risk and reward, it won't happen. And there is no need for revenge trading. Okay. So revenge trading is also very, very psychological problem. You need to calm down, accept your losses, move out, take a break. Take a break of a day or two, or maybe an hour or two, whatever, and then come back. Maybe the market is not in a good state today. Maybe the market is weird, market is volatile, market is range bound, not ready for a good setup, not ready for a good move. Don't fight with the market condition. Okay, the market does not care. What do you feel about? You have to be logical.
Right. So I can suggest some few ways to avoid revenge trading. So the first is step back temporarily. Take a break. If you've had a series of losses, don't trade anymore. Take a break of a day or two. Divert your mind. Do something else. Don't keep thinking about your loss. Don't keep thinking about your losing trades. Make a self-assessment. Assess yourself. What went wrong? What was it? Was it the strategy that went wrong? Was it the execution that went wrong? Was it the timing? So you have to analyze, you have to make a self-assessment that what did you do wrong? So if you have a trading journal, you'll be able to go and assess, right? So make a self-assessment. That is why these tools, this trading journal, backtesting, all this facts and data of your records will help you. So make a self-assessment, assess the market. Maybe it wasn't your fault. It was just the market. So we've been mentioning it again and again that market is not always trending, whether upwards or downwards. Market could be in a ranging phase, it could be in a consolidation phase. So it's maybe it's not your fault. So assess the market condition. Was it some news which impacted that particular day? So give time to yourself, give time and assess everything. Assess your trading strategy. You've had these tools, so go and assess your trading strategy. Try taking a few demo trades. So this would help you. And then, of course, you can optimize your strategy. You can make necessary adjustments and then move forward rather than just, without thinking, without any logic, just go on taking trades.
Actually, all days are not tradable. We should wait for a tradable setup. There are some days when you should stay away from the market. They're not tradable setups. They're not tradable days. So it's okay.
So we'll quickly move forward. Right. So trading without formal education or based on trade calls. So most of the people I have seen in my career, okay, they start to think that they have to invest in themselves only after potentially losing some money in the market. So number one thing that you should do is keep yourself informed, become an informed trader, take a formal education, learn and have one mentor. Okay. I'm sure whoever, there is a lot of jargon in the social media about trading. There is a lot of material on internet, which is available. So people try to learn from YouTube. So they have one mentor on YouTube. They follow one Telegram channel where they're getting some trade calls. They have one WhatsApp group. They are listening to their friends. Okay, today my friend bought Amazon stock. Why did he buy Amazon? He bought, so you will also buy. So do your own analysis. You should do your own study. So make an informed decision. Educate yourself first, and do not follow the trade calls blindly. So even if you want to take a tip from the trade call, take it, but then analyze it yourself. Check it on the chart that whether the trade call is right or wrong. So once you have learned technical analysis, once you have learned that, so you have to implement it, right? So do not get carried away and do not follow these material which is available on social media blindly. Just try to do your own analysis and study on your own.
To be honest, don't take us wrong that we are saying it again and again, and we are not against the trade calls. Okay. It's okay to take trade calls. It's okay to buy trade calls, but no knowledge or half knowledge is more dangerous. Okay. Sometimes half knowledge is more dangerous than having no knowledge, because you do not understand the market analysis, you do not understand the technical analysis. So you have started copying the trade calls without even knowing how to maintain risk, without even knowing PIP calculation, without even knowing support and resistance, the basics, the foundation. Okay. So in that case, I'll suggest you to take a formal education, to educate yourself, to prepare yourself. Then you may do your self-analysis, you do market analysis on your own, you may rate your trades, find your new setups, or you just buy trade calls. But at least now, if you're buying trade calls, after going through the education, okay, after knowing how to calculate risk, how to set your stop loss, how to set your targets, what is a good risk and reward, you will apply it with a proper system. So you have to maintain a system.
Okay, the last topic is making yourself accountable, right? So you have to make yourself accountable. You have to discuss it with your spouse. You have to discuss it with your friend or a colleague or any family member, your parents. So basically what you're doing is you are, instead of revenge trading or taking revenge from the market, you're basically venting out yourself, right? Or you are celebrating if you've had profits. So that way it will keep you in track. Okay, so you will keep them posted about your performance, your account status. So you will not be one of those traders who's hiding behind the chair or hiding behind the sofa because they don't want the family member to see if you are in a loss. So it's always good to make yourself accountable, discuss it with someone, have a just let someone know that what is happening with your account.
Actually, I've seen so many traders, because they start trading with a bigger capital, bigger risk amount than their risk appetite. And once they start losing, now they want to recover at any cost because they never discussed it with one of the family members. If you're married, you're never discussed with your spouse that you're losing in trades. If you're not married, you're never discussed with your parents or your brother or sister, your siblings. So what happens? Now you just want to recover at any cost because you can't tell them. You're hiding from them. Okay. It should be the other way around. Once you start trading, discuss with one of your family members, with your friends, so that you make yourself accountable. Once you are accountable, I'm sure you will not get into rash trades. In fact, you would be a disciplined trader because you know, end of the day or end of the week or end of the month, you are going to discuss your results with one of your family members or one of your well-wishers. So in this way, this is a technique which will keep you in control, which will not allow you, which will not let you to go for rash trades. A one trade which has almost wiped 50% of your account. You'll not be in such a situation if you make yourself accountable.
Right. So let's answer the questions quickly in the chat box. Okay, it's about the link that puts 300 on the available. Okay.
That's 300 only tradable. Yeah, if you put $200, which is the minimum required amount, and 200 is given as bonus or $100 extra, which is given preloaded, this 300 is not withdrawable. It's definitely tradable, but not withdrawable. Okay, so you can take positions on this 300. You can make money on this extra 300, which has been given to you, but your withdrawable amount is the amount which you have put in your trading account, which is $200 plus your profit, whatever you have made.
Great. So thanks a lot, everyone. And thank you for having me here, Nikhil. So I'm sure you have understood how trading psychology can impact your trading actions and how it can impact your journey of
Yes,
being a successful trader.
Yeah, very true. It's a mindset game. So apart from the trading techniques, you have to train your mind. You have to train your psychology, and you'll be a winner. You'll be successful. I'm sure, 100%. So guys, stay tuned. And in my next webinar, I'm going to teach you how to set up your trading account. If you're here for the very first time, you've never set up your trading account, you don't know how to set up a MetaTrader account, and also how to create a trading plan. Once again, I'm going to remind, if you want to sign up for a new trading account, you'll get extra benefit of $100 preloaded in your trading account if you do it right away with the link given in the chat box. Also, we have special benefits for the IBs. IB means introducing brokers who bring business to GTC, who refer friends and family to GTC, and it can be your long-term secondary income source, or it can be a full-time career, whatever. So we have rewarding benefits for IBs as well. All right, guys, take care and bye-bye.